Today, we're going to speak about how actually stock prices are determined. So what does it mean when you see prices jumping all around? What does it mean when you go to your screen and you see that the price of a stock is at $50? It's all about supply and demand. So let me explain. In reality, you have basically two queues. A queue of buyers. This side here on the left side, we call it the bid side. And then you have a queue of sellers. This side here. On the right side, we're going to have offer. On the left side, it's sorted by price. So somebody is willing to buy at $50 and they're willing to buy 200 shares. So these are the quantities and these are the prices. Somebody else is willing to buy not at the $50 price, a little bit lower price at $49.99, but they're willing to buy 500 shares. And then a third person is willing to buy at $49.98 at 300 shares. Notice that it's very important, this is sorted by price, not by quantity. In this case here, it could be 100, it could be 600, it doesn't matter. This person here has a higher priority because they're willing to buy at a higher price. It's exactly the same on the opposite side. Somebody is willing to sell 100 shares at $50.01. Somebody is willing to sell at 300 shares at $50.02. Notice again, the prices are sorted here, the quantities, they don't matter. If I'm willing to sell at a lower price than somebody else, I have the priority. Now, when does the matching happen? If somebody is willing to buy, let's say, at $50, and somebody new comes and says, okay, I'm happy to sell 200 shares at $50, that's when the trade happened. That's when you see the trade price of the stock is at $50. Now, when you look at the prices at $50, does it mean that you can just buy a limited number of shares? No, no, no. Can you go and just buy like 1 million shares at $50? Absolutely not. Remember, it's all about supply and demand. If you want to buy a lot of shares, 1 million shares is a lot of money. We're talking here about $50 million, about potentially an institutional client, but they're not going to be able to get necessarily at $50 or $50.01. Remember, if there is more demand, the prices go up. More supply, the prices go down. Now, another very important thing that I wanted to talk about is how actually do you go and you execute these orders. There are multiple types of orders, but let me talk about two of them. One is a limit order, okay? So basically with the limit order, you say, I want to buy 200 shares, but the maximum price I'm putting in is like $50.01. Well, in this case, guess what? I can get done of 100 shares at $50.01. But by putting the limit, I know what's the maximum price I'm going to get. It will never go above that. That's the advantage of a limit order. Another type of order is a market order. With a market order, you don't know the price that you're going to get executed at because prices move fast. Okay? Now, there is a very big risk with the market order that I want to highlight. So imagine in this case, you see that the stock is trading at $50, and then you go and you put a market order. Let me buy the stock, okay? Thinking that it should be around $50. But right when you press the button, right before that, what happens is like there is a news about the stock, and then the stock jumps. Somebody is acquiring the company. Well, guess what? You're not going to get executed at $50 with a market order. You're going to get executed at a much higher price, which was not your intent. So you have to be very careful with market orders. Bottom line, stock prices are determined based on supply and demand. And then you have to pay a lot of attention to liquidity of stocks and also the type of orders you are using to execute your trades. Thank you so much for your support, and I will see you next time.